The United States Treasury announced on May 6 that it will issue $125 billion in new debt next week. 3-year notes May 11th, 10-year notes May 12th, 30-year bonds May 13th. All of it settles May 15th, the same day Jerome Powell's term as Federal Reserve Chairman ends, and Kevin Warsh, whose confirmation vote is scheduled for the week of May 11th, is positioned to take the chair. The financial press is reporting this as routine. It is not routine in context. The last time the Treasury issued debt at near-record levels into a war footing while the Federal Reserve was undergoing leadership transition under direct executive pressure to keep yields low, the Federal Reserve formally agreed to peg those yields, and the savings of an entire generation of Americans lost between 30 and 60% of real purchasing power across the next 9 years. The man who fought that decision from inside the Federal Reserve, who lost the fight in 1942, who watched the consequences unfold for 9 years, and who finally broke the peg in 1951 through a single act of public defiance, was Mariner Stoddard Eckles. His name appears on the Federal Reserve Board's Washington headquarters building. The fight he lost in 1942 is the single most important fight in 20th century American monetary history that nearly nobody outside the central banking community has ever been told about. Almost nobody on cable news this week is going to connect the May 15th Treasury settlement to the April 1942 yield peg agreement. That is what we are going to do. My name is Ban. I have spent 5 months reconstructing the Eckles era of the Federal Reserve across primary sources: the Mariner S. Eckles document collection at the Federal Reserve Bank of San Francisco, the FOMC meeting minutes from 1941 through 1951 released through the Federal Reserve Archives Fraser database, the Hetzel and Leach narrative account of the 1951 Treasury-Federal Reserve Accord published in the Federal Reserve Bank of Richmond Economic Quarterly, the Levy Economic Institute working paper by Thorvald Grung Mo on Eckles and the Accord, the contemporaneous Treasury annual reports through the Korean War period, and Eckles' own memoir, Beckoning Frontiers, published in 1951. I am going to walk you through what Eckles agreed to in April 1942, what happened to American savers between 1946 and 1948 when consumer price inflation reached 17.6% in a single year while the bond yield was held at 2.5%, and what Eckles did on the morning of February 4, 1951, that finally broke the peg. By the end of this video, you will understand exactly which historical mechanism is being assembled around the May 15th Treasury auction, what the documented record says happens to savings when the mechanism completes, and what the 4 specific actions are that protected real purchasing power across the 1942 to 1951 period for the small minority of households who understood what was being done to them. Subscribe to the channel before we continue. Hit the like button. Share this video with anyone who holds Treasury bonds, certificates of deposit, or savings account balances above what they need for emergency liquidity. The decision being made this week affects them all. The first decision. April 1942. 4 months after the United States entered World War II, the Treasury Department came to the Federal Reserve with an explicit request: peg the interest rate the federal government had to pay on its borrowing. Pin the rate on 3-month Treasury bills at 0.3%. Cap the rate on long-term Treasury bonds at 2.5%. The Treasury wanted to finance the war as cheaply as possible, and the cheapest possible financing required that bond yields not be allowed to rise above the level the Treasury chose. The Federal Reserve formally agreed. Eckles, then in his 8th year as chairman, had argued internally that the war should be financed primarily through tax increases and explicit wage and price controls rather than through monetization. He lost the argument. The Treasury and the executive branch had the political authority. The Federal Reserve had been an independent institution in name since 1913, but had never tested the limits of that independence against an active wartime executive. Eckles concluded, along with his colleagues on the Federal Open Market Committee, that winning the war was the overriding national priority, and that providing the Treasury with cheap financing was the most useful contribution the Federal Reserve could make to that goal. He recorded his reservations in the FOMC minutes. He maintained those reservations privately. He did not publicly oppose the peg during the war years. The peg held. 3-month bills paid 0.3% throughout the war. Long bonds paid 2.5%. The Treasury issued $185 billion in war bonds between 1941 and 1945 at those pegged rates, financing the war at borrowing costs that no peacetime market would have allowed. The first decision was the foundation. Everything that followed was contained in it. The second decision was not made by Eckles. It was made by inflation itself. The war ended in August 1945. Wage and price controls remained in place into 1946. When the controls were lifted in stages between mid-1946 and 1947, the suppressed price pressure released directly into the Consumer Price Index. According to the Federal Reserve Bank of Richmond's account of the period, consumer price inflation between June 1946 and June 1947 reached 17.6%. Between June 1947 and June 1948, inflation was 9.5%. Long Treasury bonds were still pegged at 2.5%. 3-month bills were still pegged at 0.3%. Savings deposits at commercial banks were paying between 0.75 and 1.5% under Regulation Q. Every American who held cash savings, savings deposits, war bonds, or any conventional Treasury security was earning a positive nominal return and a deeply negative real return. A saver with $10,000 in war bonds in June 1946 received approximately $250 in interest by June 1947. The same $10,000 lost approximately $1,760 in purchasing power across the same year. The real loss was $1,510 on a $10,000 position in 12 months. The mechanism was not malfunction. It was the peg working exactly as designed. The peg held bond yields below inflation specifically because that was the point. The Treasury was paying 2.5% on debt, while inflation reduced the real value of that debt by 17%. The Treasury's debt burden, in real terms, fell sharply. The cost of that fall was paid by every saver in the country who held debt instruments. They paid it whether they understood the mechanism or not. The third decision. Truman did not reappoint Eckles as chairman in January 1948. The reason given to Eckles privately was political. Truman's staff later acknowledged the demotion was meant, in their phrasing, to show Eckles who's boss. Eckles considered resigning. He did not. He chose to remain on the Federal Reserve Board as a regular governor, a position he was entitled to hold until 1958 under the staggered 14-year terms specified in the Federal Reserve Act. Thomas McCabe, formerly chairman of Scott Paper Company, was appointed Federal Reserve Chairman in Eccles's place. McCabe had no central banking experience. He was a respected business executive whose appointment the Truman administration calculated would produce continuity on the rate peg. Eckles, demoted from the chairmanship, became the most experienced and most institutionally credible voice inside the Federal Reserve System willing to challenge the peg publicly. He spent the years between 1948 and 1951 writing memoranda, testifying before congressional committees, and giving speeches that gradually built the case that the rate peg had converted the Federal Reserve System into what he later called, in formal congressional testimony in January 1951, an engine of inflation. That phrase appears in the official transcript of the Joint Committee on the Economic Report hearings. It was Eccles's deliberate framing. The Federal Reserve was not failing to control inflation. The Federal Reserve was being used as the mechanism by which inflation occurred. Every dollar of bank reserves the Fed created to defend the bond peg fed directly into the credit base that produced consumer price inflation. The peg was the cause. The Fed was the engine. The fourth decision. June 25, 1950. North Korean forces crossed the 38th parallel. The Korean War began. Treasury Secretary Snyder and President Truman immediately renewed pressure on the Federal Reserve to maintain the peg, arguing that wartime financing required the same cheap borrowing arrangement that had financed World War II. The FOMC, including Chairman McCabe, increasingly believed the peg was untenable. Eckles, no longer chairman but still a board governor, became the most public face of the Federal Reserve's resistance. The conflict came to a head on January 31, 1951. Truman summoned the entire Federal Open Market Committee to the White House. The meeting lasted approximately 90 minutes. The minutes of that meeting, kept by FOMC Secretary Robert Rouse, show that no commitment to maintain the peg was made. After the meeting, Truman's press secretary issued a public statement claiming the FOMC had pledged to support the rate peg as long as the emergency lasts. That claim was false. McCabe, the sitting chairman, declined to publicly contradict the president. Eckles did not. On the morning of February 4, 1951, a Sunday, Eckles released the actual FOMC minutes of the January 31st meeting to the New York Times, the Washington Post, and the Washington Evening Star. He did so on his personal authority without consulting the rest of the FOMC. The minutes appeared in the Sunday morning editions. They documented that the FOMC had made no commitment to the peg. Eckles later wrote in his memoir published that same year that the disclosure produced exactly the result he had calculated. The fat was in the fire. Public debate erupted. Members of Congress who had received conflicting accounts from the Treasury and the Federal Reserve demanded resolution. Within 28 days, on March 4, 1951, the Treasury and Federal Reserve announced a joint statement now known as the Treasury-Federal Reserve Accord. The peg was over. The Federal Reserve regained authority to set monetary policy independent of the Treasury's debt management preferences. The mechanism that had transferred purchasing power from American savers to the federal government for 9 years was disassembled. The disassembly came too late for the savings already destroyed. Eckles retired from the board 4 months later. Now here's the part the financial press has never connected for the modern audience. The mechanism Eckles fought was not unique to wartime. It is structurally available to any government whose debt obligations have grown beyond what conventional taxation can service. And it requires only one specific action, a formal or informal commitment by the central bank to subordinate monetary policy to debt management considerations. The formal version of the mechanism, an explicit peg announced jointly by the Treasury and the central bank, is rare. The informal version is common. The informal version operates whenever a central bank, under direct executive pressure or through institutional capture, refuses to raise rates to a level consistent with restoring positive real yields, even when inflation runs above target. The current configuration around the May 15th Treasury settlement contains every structural element that produced the 1942 peg. The federal debt is 123% of gross domestic product, higher than the 119% peak reached at the end of World War II. The Treasury is issuing debt at near-record quarterly levels. $125 billion per quarter has been routine since 2021. The executive branch has applied direct, public, and sustained pressure on the Federal Reserve Chairman to lower interest rates, including a criminal investigation that was dropped only after the Senate confirmation hurdle for the new nominee required it. The new Federal Reserve Chairman, scheduled to take office on May 15th, has publicly argued that the Federal Reserve should cut rates preemptively, citing artificial intelligence productivity gains as a deflationary offset that justifies easing despite inflation running above target. Inflation is currently running at 4.4% according to the IMF April 14th release. The 10-year Treasury yield is approximately 3.8%. Real yields are slightly negative on the long end of the curve already. The structural conditions that produced the 1942 peg are present. The peg itself has not been formally announced. The mechanism is operational without a formal announcement. Less than 1 in 10,000 savers in the United States can name the Treasury-Federal Reserve Accord of 1951. Less than 1 in 100,000 can describe what the rate peg actually did to their grandparents' savings between 1946 and 1948. Your financial advisor has not described the current Federal Reserve configuration in terms of the historical Eckles mechanism. Your bank has not. The mainstream financial press will use the phrase fiscal dominance only in occasional academic-adjacent essays tucked behind paywalls. The phrase is not promoted because the phrase changes the framework. Once you know that the Federal Reserve has, within living memory, formally subordinated itself to Treasury debt management preferences while inflation ran at 17.6% and savers lost a generation of real wealth, the conventional advice, hold long-duration Treasury bonds for safety, hold cash savings for emergencies, hold Series EE savings bonds for patriotic reasons, stops sounding like prudence and starts sounding like compliance with the Eckles mechanism running for the second time. So what does the historical record say a saver should actually do when the mechanism is operational? The two specific numbers to track instead of daily Treasury yield headlines. The 10-year Treasury inflation-protected security yield, currently approximately 1.8% and retreating from a March peak of 2.13%, and the spread between the headline 10-year nominal Treasury yield and the headline 12-month Consumer Price Index. Subtract the second number from the first. The result is the real yield available on the standard long-duration Treasury benchmark. When the result is negative, when nominal yields run below current inflation, the Eckles mechanism is operational, regardless of whether anyone has formally announced a peg. As of the second week of May 2026, the headline 10-year Treasury yield is approximately 3.8%. The IMF inflation projection for 2026 is 4.4%. The implied real yield on a new 10-year Treasury bought at the May 12th auction is negative 0.6%. Buyers of that 10-year note will earn 3.8% in nominal interest annually. Inflation will reduce the purchasing power of those interest payments and the principal by an additional 4.4% annually. The buyer is paying the federal government 0.6% per year in real terms for the privilege of lending the federal government money. To make that concrete in dollar terms, a saver who buys $10,000 of the new 10-year Treasury at the May 12th auction will receive $380 in nominal interest annually. The same $10,000 will lose approximately $440 in purchasing power across the same year. The net real loss is $60 per year on every $10,000 committed. Across the 10-year life of the bond, if inflation runs at the IMF projection, the real loss compounds to approximately $600 on the original $10,000. The buyer ends the 10-year holding period with the original principal returned, plus $3,800 in nominal coupon payments against approximately $4,400 of cumulative purchasing power destruction. The instrument that the financial advisory industry calls SAFE, the 10-year United States Treasury note, is mathematically guaranteed to lose real purchasing power at current yields and current inflation. This is the mechanism Eckles fought. It is operational right now. The auction is May 12th. Less than 1 in 1,000 retail investors who participate in next week's Treasury auctions through their brokerage account will have computed this number before they place their bid. The number is publicly available. It requires basic subtraction. Watch it. For instruments that have historically protected purchasing power when the Eckles mechanism is operational, 3 categories. First and easiest, move your cash. The current top high-yield savings rates available in the United States as of this week pay between 4.10% and 5% annual percentage yield, according to Current Bank Rate, NerdWallet, and Fortune surveys, with strong options including CIT Bank at 4.10, Pi Bank at 4.40, Axos Bank at 4.21, and Vero Money at 5%. The FDIC national average is currently 0.38%. Moving an emergency fund from a national average savings account to a top high-yield savings account closes most of the real yield gap immediately, with no downside, in approximately 30 minutes online. The move does not require selecting an investment. It is the same federally insured deposit product, paying a higher rate at a different institution. Almost nobody does it. Second, I-bonds. Series I United States savings bonds, sold directly by the Treasury at treasurydirect.gov, are designed specifically to protect purchasing power against inflation. The interest rate has 2 components, a fixed rate set at purchase and an inflation rate that adjusts every 6 months based on the CPI. When inflation rises, the I-bond rate rises with it. The bonds are exempt from state and local taxes. Federal tax can be deferred until redemption. The annual purchase limit is $10,000 per individual through Treasury Direct, plus an additional $5,000 using a federal tax refund. The bonds must be held for 1 year minimum and pay a 3-month interest penalty if redeemed before 5 years. They are not liquid for emergencies. They are designed for the portion of savings beyond an emergency reserve that does not need to be touched for at least a year. I-bonds are the single instrument the United States Treasury currently sells directly to retail investors that is structurally designed to defeat the Eckles mechanism. Almost nobody buys them in proportion to the protection they provide. Third, gold exchange-traded funds. SPDR Gold Shares, ticker GLD, and iShares Gold Trust, ticker IAU, are the two largest physically backed gold exchange-traded funds in the world, both eligible for traditional and Roth IRAs. During the 1946 to 1948 period, when the Eckles peg was producing 17% inflation against 2.5% bond yields, gold was illegal for American citizens to hold under Executive Order 6102, which had been signed by Roosevelt in 1933. The legal restriction was not lifted until December 31, 1974. American savers during the Eckles era did not have access to gold as an inflation hedge. They had no functional equivalent. They lost the wealth. American savers in 2026 have access to gold without restriction. A small allocation to GLD or IAU, 5 to 10% of total household financial assets, has historically protected purchasing power across exactly the kind of monetary configuration that produced the Eckles outcome. The instruments your grandparents did not have are now available. The framework that destroyed your grandparents' savings is now operational again. Mariner Eckles spent the morning of February 4, 1951, with the Sunday newspapers spread across the desk in his Federal Reserve Board office in Washington. The FOMC minutes he had released the previous evening were on the front page of the New York Times, the Washington, and the Washington Evening Star. He had acted on his personal authority, without authorization from the FOMC chairman, against the explicit wishes of the President of the United States, knowing that the action might end his career. He calculated that the institutional independence of the Federal Reserve was worth that risk. He calculated correctly. The Treasury-Fed accord followed within 28 days. The peg was over. The mechanism was disassembled. The savings already destroyed by the 1946 to 1948 inflation surge were not recovered. They were gone. The lesson of the Eckles era is not that central bank independence is a permanent achievement. The lesson is that central bank independence is a continuous discipline that breaks under sufficient executive pressure into a sufficiently large debt configuration, and that when it breaks, savers pay the cost in real purchasing power across years that compound. The Treasury auction on May 15th is $125 billion. That is routine in size. It is not routine in context. The new Federal Reserve Chairman taking office the same day has publicly argued for preemptive rate cuts. The federal debt is at a higher percentage of gross domestic product than at any point since World War II. Inflation is running above target. Real yields are negative. The mechanism Eckles fought is operational without a formal announcement. This is BAN. The peg always breaks. The savings do not return.